Thank you for joining Q3FY22 Earnings Conference call of Bata India Limited. From the management team, Mr. Gunjan Shah, Managing Director and CEO, and Ms. Vidya Srinivasan, Director of Finance and CFO. I would now like to hand over the call to the management team for opening remarks, post which we will start with the Q&A session. Thank you, and over to you, sir.
Thank you, Ambit. Hi, everyone. This is Gunjan Shah here. You must have already got the investor presentation, right? So thank you for joining this call. This is in continuation to the quarterly call process that we've started since the last quarter, right? And we will hopefully sustain it going forward. So jumping right into the presentation, right? I will take you all directly into obviously some kind of an overview, a recap on basically some of the strategic levers that we've talked about. We will see the key highlights. I'm on slide 3 of the quarter gone by, and ending with some financial summary. With that, I'll move into slide number 5. As you can see, we are obviously India's most loved footwear brand. We've got in excess of 1,500, actually closing towards 1,600 exclusive stores across the length and breadth of the country, split all across geographies and size of towns, and expanding. We also have various brands that are catering to various segments of the consumers across the strata. Yeah. Moving further to slide number 6. I have spoken about this last time. This is just to make sure that there is consistency in the direction that we are taking. So I'll quickly go through them. Obviously, the first one is the point that you see bubble at the top, which is drive portfolio evolution, making sure that we are relevant to consumers and their needs as time and as the times have also shown in these COVID times. But otherwise also, there are longer term trends also that we need to make sure that we are ahead of the curve. The second piece is, what I've mentioned many times in the last several months, that the equity of Bata cuts across a swath of the country. And therefore making sure that we are available widely, and therefore expansion through both exclusive outlets with the franchise route as well as distribution of multi-brand outlets. We had a brief hiatus in terms of our marketing investment. The marketing journey got a little interrupted during the COVID times, but making sure that we get back our marketing investments and make the Bata brand younger. Obviously exploring the digital footprint, both in terms of commerce as well as the way we engage with consumers and our media spends also. Making sure that our back end is agile and efficient, and also we stay nimble on costs and look at where we can basically variabilize cost structures in this dynamic environment. At the heart of all this is also continuously making investments as well as efforts towards enhancing the talent, the processes, as well as the technology platforms on which all these thrust levers work, and continue being a responsible citizen. That's a proud legacy that Bata carries, and that is something that we want to keep on. Moving further to key highlights, slide number 8, the first one, which is on drive retail excellence as well as portfolio evolution. What you see on the bar graph is a continuous recovery chart. As you see, even in this quarter, we saw significant recovery. All of this is compared versus pre-COVID levels, which is 2019 equivalent. These numbers were obviously significantly ahead of 2020. And this was driven obviously through great consumer sentiment recovery that we saw during festive season specifically. And I think there was some amount of impact that we saw because of the range refresh that we had started from the last quarter post the wave subsiding, the second wave. There was, I think, a significant outperformance that we saw in terms of Hush Puppies and North Star, driven by sneakerization and casualization in various portfolios. And we also started investing back into our stores with significant refresh of stores. That has now started building into a very large funnel. So this is pure retail sales. Moving further, I think in the portfolio, I have spoken about this. Sneakerization is a big trend within the larger casual trend, and I think that's something that we have invested. We are committed to this journey of making the sneaker association of consumers to Bata a very strong pillar of our growth. We started seeing that this started leading our recovery and growth. It was well ahead of 2019. I think while overall we were in the mid-90s in retail, but sneakers was well ahead of 2019. So it started showing results. We are very hopeful and optimistic of the kind of traction that we are getting of various initiatives. Range obviously got expanded. We also expanded the pilot of sneaker studios. Now it's further gone up, and I think with this kind of great results where that delta was even faster at almost a 6% increase in the mix of sneaker sales within these stores, we will look at a significant expansion. The plan for this year is almost 20% of our footprint should move towards sneaker studios as a shop-in-shop. Moving further, drive retail excellence. I think this has been a big cornerstone. This is a new concept that I'm bringing to all of y'all. We had started initially this in 2019, but now it's been ingrained. It is now spread all across. It's called Net Promoter Score, which is basically now an indicator of what is the consumer experience after the consumer has visited our stores. And that is independently measured by an agency directly probing the consumers. It gives us a very good understanding at a granular level on various levers that can influence consumer experience, right from the merchandise, the ambience in the stores, to basically, let's say, the outlook of the stores, as well as the staff behavior, etc. This is now being ingrained in terms of the various processes, the incentive structure of the store, etc. And what you see on the graph, while this is something that's just the first 3 months, but we will obviously come back to you all regularly, is that we've seen a positive trajectory on that front, and the overall NPS for our network stands at just a shade below 70. The benchmark that we carry is in the range of about 65 to 75. So we would like to be top quartile on this, and hopefully we'll keep updating you on this front. But it's going to be a key parameter in addition to obviously same-store sales, etc., that we'll keep pushing on. Moving to the next chart, which is on distribution expansion and multi-brand outlets. This is a big growth engine for us. I think it's done exceedingly well. This is a second quarter after the second COVID wave, right, in April, May, June, where we've seen further progress. The first time now the multi-brand outlet distribution has crossed 1,000 towns. The number of distributors and therefore the potential of sales that they capture is what I would say is the next graph, which is WD. It has now moved up to almost 28% versus 19% only 2 quarters back. So that's significant progress and indicates that the platform is getting stronger and stronger. This has also been obviously backed by a significant amount of work on customized portfolio for this channel, which is very different from a retail channel. However, this is something that I still feel has a lot of legway in terms of the kind of growth that this can deliver. As I said, the brand equity of Bata extends far wider than the number of towns and the pop strata that we currently service through our exclusive brand outlets. So it will keep expanding and we'll keep updating you. But it's been a good quarter on that front. The next one, which is another lever for expansion of the franchise of Bata, the franchise model, it has picked up further pace. As you can see the snake line, which is a line graph below. 2 years back, we were in about the mid-100, about 150, 160 stores. Now we are close to 300. Last quarter we ended at 284. It was the largest addition since COVID hit us. And we see this funnel only building up. So, the previous quarter I updated you with about 16 store additions. This quarter has been 34. And I'm sure we will make much more progress. As I've said multiple times, I think the first milestone is to make sure that we at least cross 500 in the next about couple of years. And we are well on our way on that front. It also gives us access to many more towns and consumers access to their loved brand of Bata. We are also backing this up on this franchise to make sure that we are, I think the key cornerstone is that one is that we make sure that we are looking at like-for-like growth, and that has been extremely healthy. And the second piece is that similar consumer experience measures are being applied. So it's not going to be only inorganic, but it's also that there is a lot of potential in terms of making sure that the organic piece of like-for-like also continues, backed by some strong process interventions. Moving to the third growth engine, which is digital footprint. We've seen good progress. The same growth journey continues. It has been one channel that has grown through COVID, and we are now driven by all the three levers of marketplaces, omni-channel and e-store, which is our own online store. The online store is now our largest store if you look at it compared to our offline stores. But however, I think all three have contributed to an overall growth where we have seen that the digital footprint commerce has actually doubled versus pre-COVID levels in the quarter gone by. And that journey will continue with a lot of levers being applied on all the three channels of growth that are there within digital commerce. The next chart is basically talking about bringing back marketing investments to brand Bata. There was a significant upshift, as I had mentioned even in the last quarter call. Right, we obviously, as soon as we saw that the business and the sentiments are recovering back, the first right to resources is investing back in marketing after a hiatus, as I have said in the last 18 months. We saw significantly higher, 34% specifically, sequential growth in marketing investments, focused towards two large campaigns. One was towards the festive casual campaign, and the second one was basically the unlimited sneakers campaign. In fact, the unlimited sneakers campaign was the first time such a large, purely digital campaign was rolled out. And hopefully you've managed to see some snippets of it and you've liked it. But that is something that's given us, as I mentioned in the sneaker section, has given us good response also. So that journey will continue, and that journey will get reinforced by the fact that we are also welcoming a new brand ambassador on board, Disha Patani, and she is a youth icon, she's a fashion icon, and she's a fitness icon. These are the three pivots on she stands very strongly. She's got one of the largest, digital following, and we hope that this association will take Bata brand further, along with connecting it with the youth in India. Other key highlights, I think, what I'm proud most about, while you see a lot of points out here, is that we managed to, actually in the middle of the quarter, pretty early before Diwali, we managed to hit 100% vaccination across all our employees and partners. And I think that worked well, not only from an employee safety perspective, but also from a assurance to consumers. So we were also recognized as the best employer brand by World HRD Congress for North India. And our social work, which was towards food donation, etc., and schools, is something that continued. We did see higher rent savings than our target in quarter 3. However, sequentially that did come down, largely because obviously since market opened, obviously we had to be fair to our landlords. We also saw, the GST regime have an impact on footwear, and we managed to make sure that we take adequate actions. What I will do is, I will invite Vidya to speak a little more on the GST action and the successful manner in which we navigated it.
Right. From a GST standpoint, obviously the rate revisions have happened from 5% to 12% for below 1,000 articles, and this impacted a fairly significant part of the Bata product range. I think we were able to take a series of actions over a fairly short period of time. I think across 30 to 45 days, we were able to take price action. We revised the pricing of existing POs that were available. We also did some amount of re-stickering where we revised MRPs on products at stores. We also did a fairly aggressive communication campaign amongst customers to explain the rationale for price increase, which I think we found positive. I think there was a clear consumers were able to be understanding of it, and we did not get any significant pushback. In addition, we've also kind of given system changes that needed to be done within that period of time, and we've also given incentives to our channel partners, etc., and to support them in the stock clearance in line with industry practice. So a series of actions which happened over a short period of time.
And both of these actions were making sure that both the The immediate impact on our stock covers, etc., is neutralized to the largest extent possible, as well as ensuring that the margins are intact going forward. We are also working with the government and the associated authorities in terms of trying to work towards a single rate of GST, which I think is the right way forward. It simplifies a lot of things. Right now, there are two GST rates of 12% and 18%. Then moving forward to the last chart, which is the financial summary, the revenue and the PBT trend line. As you can see, basically the last quarter was at 841 crores, marginally and higher than the last several quarters, even ahead of quarter 3 of 2019. And what you see is on the PBT chart, the recovery on the profitability journey continues as scale builds up on our various channels and revenue streams. So that ends my presentation, and with that I'll hand it back to Ambit to take and organize the Q&A. Thank you, gentlemen and ladies and gentlemen.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants, to ask a question, please press star and 1 at this time. The first question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi Gunjan, hi Vidya. First of all, thanks for keeping up the promise and doing this call. Hope this quarterly communication continues. And also, thanks for a very detailed presentation. So my first question pertains to any reason why retail segment recovery in the quarter was back-ended. If we compare it with other retailers, they had very good October, November, and December actually got impacted because of Omicron. In our case, it seems slightly reversed. So if you can help us with that, and also SSG for the quarter.
Yeah. So basically, I think we saw momentum building up. I think there would be basically two angles that I can possibly answer. I mean, I am not able to, maybe compare different consumer segments and therefore profiles of businesses of different retailers. But broadly, I think towards the festive season, it started peaking for us. We did see some impact of COVID, Omicron third wave coming towards the end of December. But I think, the trends were what we saw. Right, so we are hopeful that the impact of the third wave also will be relatively muted, but that we will update you as soon as we get some clarity on that front.
Sure. Second, and this is slightly long-term question. So see, from FY15, Bata as a company has struggled to deliver double-digit revenue growth. In fact, 11 to 15 was a very good period, but it was somewhat at loss of margins. And we reversed the trend on margins, but revenue growth actually moved back to mid-single digit to at best high single digit. So what are the strategic initiatives you are taking to make it structurally much more stable in terms of both profitable growth engine, and what are you actually in your initiatives that we are taking right now, what are you gearing up this company for? What kind of growth trajectory should it be? At least aspirationally, are you targeting mid-teens, high teens, or low teens as of now?
I think you've asked a lot of things in that one question, but I think the big thing that while we don't give forward-looking statements, but however, I think the piece that I would like to highlight and make you understand is that there are multiple levers. I think one is that basically making sure that as I said, I think the growth will be driven on the retail front by 2 or 3 things. One is wider access to a more flexible business model driven by franchise, which is lower on capex as well as fixed cost outlay, so makes us far more agile and nimble. But simultaneously also driving up retail excellence, which I have also talked about in the presentation today. That is one. The second one is obviously making sure that our access is far wider through even the multi-brand outlets, because India is far larger than what you can possibly service through an hinterland because every store of ours at most basically has a hinterland of not more than a few kilometers around it. And therefore, there's a limitation to how much you can expand or scale on that front alone. And therefore, I think the multi-brand outlet journey that I've talked about and which will continue, I think is going to be another big growth lever. Besides, obviously, I think e-commerce. I think one other piece that we will also see is going to be something called shop in shop. I see there is a huge potential on that front also. I think right now our penetration in shop in shop compared to the benchmarks that I get to hear, I think there is we would be at about 10 to 15%. So there's a huge penetration of visibility as well as availability of Bata products that can be possibly made through various lifestyle and departmental stores. So all of these levers will basically make sure that the growth trajectory is balanced as well as is driven holistically. Besides this, I think there are two others. One is obviously, as I said, the marketing piece, which is making sure that we are able to connect to the youth better, right, and make sure that the journey which was initiated with surprisingly Bata about 3-4 years back continues aggressively in terms of lowering the average age of our consumers. And the second piece is going to be on the merchandise and the category front. It's very, imperative that we latch on to basically the growth category, which is sneakers and casualization. So expansion, I would say youth connect as well as growth categories, all three combined are what are going to hopefully change the growth trajectory going forward.
Sure. And just last one, and I'll try to combine two questions then. So first is a share of school shoes in our overall turnover, A. And B, if you can help us understand in terms of trade on franchise stores, basically, does the billing happen on MRP basis and it is captured in Bata's P&L, or it is net of commission which shows up on our numbers?
Schools, we did see a recovery. I didn't mention it specifically in my presentation, but we did see a recovery in schools, right? However, I would say that the full-fledged school recovery is still to happen, and it's understandably so. I think we will need an extended period of assurance to parents, I guess, and obviously the school authorities to make sure that it is continuously open and therefore the footfalls or attendance in school goes up, right? But we did see a significant bump up. I think it's a little optical from a point of view that a school season gives us a significant bump up, and we did see a recovery. So I am very hopeful that with the COVID impact moderating going forward after the third wave, we should see an even larger recovery coming back. The second piece that you mentioned on franchise commercials, I have said this in the past. We basically do it on a net of commission basis, right? And it is significantly accretive to our profitability.
Okay, that's all from my side and all the best.
Thank you.
Thank you. The next question is from the line of Bhargav Buddhade from Kotak. Please go ahead.
Yeah, good morning, team, and thank you for the opportunity. My first question is on your cost items. If you look at employee cost and other expenditure, both are significantly up on a sequential basis. So is it more investment-led kind of an increase, or how should we look in terms of this increase which has happened on a sequential basis?
Right. No, thanks for that question. I think so. There are two angles, right? One is that there has been an investment in talent, etc., that we are working on structurally, right? Obviously with productivity in mind, etc. But then there's just one quarter. But that's one angle. The second piece also is that since we saw significant bump up, we had to also see how the full year incentives are working out, and we had to provide for it. So some part of it is one-off, some part of it is, I believe, structural in terms of talent and capability built up in the company.
And in terms of other expenditures, sir, there has been a significant increase Q1Q.
Some variable costs which is function of higher sales, which is also impacted during the quarter. So I think that is largely the reason for the increase in other expenses.
So does this other expenditure also include some amount of rent?
The rent concession piece, obviously a lot of it was booked in the September quarter, and we are seeing relatively lesser of it in this quarter, so that explains the sequential piece.
Secondly, you mentioned one-time incentives given to sort of compensate for the GST increase. Is it possible to quantify that amount?
I would say approximately about 7 crores would be the impact of that particular piece for the quarter.
In terms of gross margin recovery, as compared to pre-COVID levels, we are still about 800 odd bits lower. When do we expect gross margin recovery to hit back to pre-COVID levels?
See, so there are 2-3 parts to this. I think one is that our sales margins are intact, and as we, as Vidya gave you a brief on the GST, we have managed to make sure that we navigate even the GST impact pretty seamlessly. So the sales margins are intact. In fact, the mix is actually more, going forward going to work in our favor. Similarly, even, the quarter has seen lower markdowns, though our markdowns are not very large in general. The margin piece, however, is also to do with the fact that we have to see the channel mix. And as I mentioned, as retail keeps recovering, while we are working on basically variabilizing some of the cost structures in retail, etc., but a significant flow-through happens once the scale impact starts coming through, which we can see sequentially from, let's say, a quarter 2 to a quarter 3. And that will keep flowing through as we go forward, as we see retail recovery.
So, are we sort of budgeting a full recovery, maybe FY23, assuming it's a normal year?
We don't give a forward-looking statement, but we are obviously very hopeful of it. We have seen good traction in the period when things were, moving to a normalization, and we are hopeful that we should see a much faster and a shallower impact of the third wave.
And sir, last question would be, what is the volume sort of comparison as compared to pre-COVID?
Volumes, I would say pre-COVID, I think the volumes were in line with the values. So I think, in fact, volumes were marginally higher. And while our average selling prices went up across channels, but however, the distribution business, the franchise business, etc., gave us a significant bump up on volumes. So overall, I would say volumes were at par with values, maybe marginally ahead.
Just one clarification on the employee cost. You mentioned investment in talent. So is it more to do on the distribution side or more to do on the retail side of the business?
You are moving ahead of your 2 questions, but yeah, sorry, can you just repeat your question, please?
Sorry for taking a lot of time. So on the employee front, you mentioned investment in talent. So is it more on the distribution side of the business or more on the retail side of the business?
Largely towards the growth engines. So, I would say, let's say the digital business towards the distribution business, also in some spaces towards, let's say, some technology as well as process improvements that we are working on.
Okay. Thank you very much for your answers and all the best.
Thank you.
Thank you. The next question is from the line of Aditya Bagul from Tata Mutual Fund. Please go ahead.
Hi. Good morning, gentlemen, and thank you for taking the question. So my question is more in terms of the operating cost. We've seen a sequential increase of about 50 crores in our operating overhead. Can you help me break that down? I believe that there will be some numbers which would come from the GST discount, etc., that we would have done. But can you help me break this down into some of the individual components?
So can you just repeat that question? It got muffled a little.
I'm sorry. I hope I'm audible now.
Yeah, you are audible.
Yeah. What I was wondering is, our operating overheads have increased by about 50 crores on a sequential basis. Can you help me break that down into some of the individual components, which is A&P, some one-time GST-led discounts, and a few other sort of line items there?
Yeah, I will let Vidya answer this. Yes.
Right. I think a large component of that would be really on account. So there are 2-3 buckets of expenses. We have one is payroll, where we have had an increase in terms of some of the incentive pieces that Gunjan has already talked about. The second is we've had marketing expenses slightly higher than the previous this thing of about 6 crores. We've also had rent concessions. The rent concessions were largely booked in the September quarter. So we had 26.4 crores worth of rent concessions which were booked in the September quarter. 4.7 crores in the December quarter. So that also contributed a significant chunk of this particular bridge.
Okay.
Some variable expenses because of higher sales during the quarter.
And one-time GST, in fact, that we talked about a little back.
Right. May I also push on a little further on this? Would there be a significant number coming from A&P as well? Because the difference still is quite meaningful.
Right. So we said about 6 crores worth of A&P has gone up during the quarter because obviously the sales have been significantly higher in this quarter.
Marketing investment.
Yeah, the marketing investment.
Yeah, no, so I think the multiplier effect that we see of marketing is significant, right? And as I said, we had to also make sure that our engagement, which had a gap in basically with consumers over the last 18 months, we have to also make sure that we more than make up for it. So, but as a percentage, I don't think we should vary that much, right? Because we expect obviously the volumes and the revenues to keep going up also.
Fair enough, sir. So my second question is more long-term in nature. When we look at, let's say, FY23 and 24, there are several initiatives that we've put in place, all of which is likely to have a disproportionate impact on our margin. Would it be safe to say that we are right now looking at probably the trough in terms of the margin, and we could expect meaningful improvement in terms of EBITDA margins from here on onwards?
No, so see, as I mentioned, I think the point is leaving aside any one-off, etc. that we mentioned during this quarter, right? The point is that we see obviously scale giving us significant flow through on margins. Besides that, I think the other piece that that there is a lot of work that's happening is on various cost optimization measures, right? While the rental piece has done well for us over the last 2 years, but looking at basically manpower productivity, especially on the front line and the back end, right, is going to be one big lever. The other is to basically make sure that we are one of the largest, in terms of volumes from a sourcing perspective, and that scale benefits should start flowing even more so going forward. And also many other initiatives on material substitution and standardization. So these are all various levers that we are working on. I will not be able to give you a forward-looking statement on margins per se, but obviously the direction is what I have just mentioned.
Understood, sir. That's very helpful. Thank you so much and best of luck.
Thank you.
Thank you. The next question is from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi, sir. Thank you. Thank you for taking my question. You did briefly mention about the store renovations restarting after COVID. How many stores you feel require immediate modernization? What will be the trajectory and the outlay over here?
I would say that basically while the quarter saw a significant start on it, but a big part of that work that happened in the quarter was funnel build-up, and we'll see in this year a lot of that showing up in terms of what is the impact on the ground, as well as obviously on same-store growth, etc. going forward. We do see a very direct correlation of a renovation of a store to a same-store growth going up by a delta. And I think this year we plan to do small and large because we've developed efficient models of store renovations. But small and large, we should be looking at almost about 200 stores going through renovation this year. It will be almost 15% of our footprint, or 15-20%.
And the outlay for that will be the expenditure for that
would be in the range of about
16 crores.
Yeah, so about in the range of about 15 to 20 crores.
To 20 crores. Understood. The second question, so this, you did briefly mention about this with some of the earlier participants. But see, one of the other occasion-led footwear brand had a good mid-teens kind of 2-year revenue CAGR. While I understand some segments like possibly school wear are not fully recovered for you, but what other factors limited the recovery for you, which can probably come back in terms of pent-up demand?
I would say that basically it's a question of also, the occasions as well as festive season. So wedding, etc. does have a significant bunching up effect, and the contribution of that kind of a consumption to your business. But I would say that I think, there are multiple levers that can impact. I think one is obviously this entire piece of, formal as well as schools coming back big time. And the second big piece that I see is going to help in terms of, going forward is going to be the sneakerization and casualization agenda from a category perspective. Besides the footprint and the other levers that I just talked about.
So Gunjan, just a follow-up on that. Has the women part of the business recovered well for you?
Which is what I said. So as I gave you some indications, right? Some of the businesses that did well was basically, let's say, the ladies segment. We also had good recovery from as I mentioned to you on the sneaker agenda. We did have some supply issues on our floats, which I talked about, because largely the response was, far beyond what we had initially estimated. We ran out of inventory, but now that's getting back in, and we are now seeing that, obviously all that momentum coming back as we got the inventories coming back in on the casual footwear section. So all of these should aid recovery going forward.
Great. Thank you, sir. That's it from my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Trilok from Aditya Birla Sun Life Insurance. Please go ahead.
Yeah, hi. Good afternoon. Thanks for the opportunity. Just wanted to check. When you compare our results, to versus pre-COVID levels, the gross margins of our business, were at around 58-60 levels, and now we are at 50-58%. So, is it fair to assume that it's mainly a mixed impact, or is that something else that we should be kind of aware of?
No, so as I mentioned, Trilok, actually mix has been. I would say that there are two parts to mix, right? The product mix has been largely intact from a sales margin perspective, right? The channel mix does play, and that is what I mean by basically retail recovery continuing further and the scale following through. And that, as I said earlier in one of the questions, that we can see that scale follow through coming through between the September quarter and the December quarter, and that as recovery and scale up goes beyond 2019, we should see that flowing through. The other pieces are some of those one-offs that Vidya talked about, right, when she was answering another question. We also had, I think, one point that we have not touched upon, which is that we had to also make sure that we reserved for obsolescence. Right, there was a certain amount of obsolescence in certain key categories that we had to provide for, which is again a one-time impact. Hopefully, I don't think we should see that going forward. Largely an accumulation of the impact over the COVID period, etc.
What's the kind of number of that obsolescence or an inventory write-down that you took?
Yeah. I think between 2 to 3% is what all of these factors would account for.
On the margin piece. So
2 to 3% on the EBITDA margin, is you're trying to say, right?
Yes.
So that is a one-off which will not be repeated in the future. Is a fair assumption to make?
Yeah, that's a fair assumption.
Okay. And lastly, on the formals wear sort of which you have also alluded to from market share perspective. How are you seeing in context of that particular category growth rates, and what's the kind of outlook?
There are two ways to look at this, right? One is that if you look at it from a sequential perspective, formal wear bounced back very, very significantly. But when you look at it versus 2019, which is also a good benchmark to carry, I think there is still some headway. It will be lower than the overall recovery, and which is what I said, that those things require a little more sustained opening of workplaces / schools, etc. And we should see that bouncing back. But if sequential is any indicator, it just shows that as soon as there is some stability on that sentiment front, we see that bouncing back pretty strongly.
Understood. Thanks. I will come back in queue. Thank you very much.
Thank you.
Thank you. In the interest of time, participants are requested to limit their questions to one per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Amar Kalkundrikar from Nippon India Asset Management. Please go ahead.
Yeah, hi. Thank you for the opportunity and for a very informative presentation. My question is on slide 11, this distributor WD percentage. I missed your comments in the initial remark. What does this 28% pertain to? Is it the salience of wholesale business now in our sales?
No. Basically, what it says, is that Amar?
Yeah.
Yeah, okay. Amar, basically it gives you a sense of what is the kind of potential of, the size of distributors. So it basically tells you that not only number of distributors, but also the size of potential of distributors that we are trying to capture. So it is, in a way, a quality of distribution metric, which is the closest that we could right now measure and therefore share with you all. So it is basically an indicator of the potential. So it also, the flip side of this is to say that 72% of potential we don't access yet.
Okay, understood. And can you then share the total salience of wholesale, that is franchisee plus distribution, in this quarter versus, let's say, pre-COVID?
In the range of, it has significantly moved ahead, but I would say it would be combined together in the range of about 20%.
Okay. And last question, sir, is on margins. I don't, I'm not sort of asking or requesting for a guidance here, but qualitatively or directionally, do you see a need for greater reinvestment in the business before the scale benefits start showing off? Or do you think if we have next year as a normal year, there is no reason why we shouldn't go back to what was the margin before COVID hit us?
I would tend towards the latter statement, but I'll refrain from a forward-looking statement.
Thank you very much, sir. That's good enough. Thank you.
Thank you. The next question is from the line of Gaurav Jagani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, my question again pertains with regards to the gross margin. So while the gross margin have been impacted on the various counts, but would it be fair to say, that given the increase in the contribution from the franchise and the distribution, and given the work that we are also doing to increase the contribution ahead, structurally, while there would be some impact on the gross margins ahead, and that might be reversed in the EBITDA margins, however. So would that be a right understanding?
Can you just repeat it? So have you understood the question? Can you just repeat it, Gaurav?
Sure. I'll repeat it again. So basically, with the increase in the contribution from the franchisee and the distribution fee, do you see the gross margin may be impacted versus the historical levels a little bit?
So I think I'll answer it in two ways, Gaurav, and Vidya, you can tell me. But basically, see the line items of, and I think I have mentioned this last time also, is that the line items of costs are differently measured because in a direct operating store model, which is retail, right, a lot of the costs are coming after the revenue line. Whereas, as I mentioned in franchise to some other question, right, analyst, which was basically that it is net of commission, so the costs are largely taken care of, right? So gross margin is not necessarily the only indicator, but flow through to EBIT and operating margin is the right way. And there, both these channels are at par or even better as scale goes up in these channels. Does that answer your question?
Sure, sir. So basically, it gets compensated below the DA, right? That is right.
Absolutely. Right? Absolutely. Got it right.
Yeah. And so the next question, is with regards to, again, the other expenses line big. So if we compare it versus the pre-COVID level, the December 20, which was a rather a normal year, and the sales there was also very comparable. Just this quarter, we just have a 1% higher sales. But if we look at the expenses, there is a sharp increase. So at that point in time, if I include that 120 crore expenses with regards to the rent and the other expenses total. But if I see in this quarter it's around 170 crores. So I mean, I do understanding of that there was an increase in the marketing bit here vis-a-vis QOQ. But about when we compare it to the pre-COVID levels.
You've answered this question in just a
So mine more to pre-COVID levels, actually, not the YOY or the QOQ basis.
No, I think there have been some expense increases, a little bit from a marketing standpoint. There's been some from a variable cost of sales standpoint, since obviously some of the growth engines have been growing quite sharply compared to the 2019 levels. So I think that would be a mix, but we've already addressed it.
Talent piece.
Yeah, and also obviously there's been some payroll costs which will happen because of increments.
So
I'm sorry to interrupt. Maybe request you to come back in queue for follow-up questions. Thank you. The next question is from the line of Ashish Kanodia from Ambit Capital. Please go ahead.
Thank you. So, two questions. One, you talked about like-for-like and same-store sales growth being an area of focus. And given that in the last 18 months or so, we have increased our intensity both in terms of opening franchisee stores as well as in terms of going deeper into distribution. So can you help us understand how the like-for-like growth has been compared to pre-COVID levels versus 3Q20? That's the first one. And the second question is, in the presentation you have talked about flexi manpower in stores. So if you can just help us understand, what exactly we are doing in controlling the manpower cost and having more variable structure. Thank you.
Sure. So one is that like-for-like in our exclusive stores, was basically higher as far as our retail sales go, largely because we have done some store rationalization, right, which I have talked about during these, unprofitable stores, etc. So like-for-like was actually higher than the overall retail recovery that I showed you all. So that's as far as your first question goes. On your second piece, which is on basically flexible manpower and variabilization of the retail cost structures, right? I think there's a lot of groundwork and progress that is happening. I think the outputs will show up over a period of time. I would say that right now about 10% of the retail manpower has moved into, flexible manpower. The concept is largely very simple. There is a difference in the way the footfall patterns in the stores are throughout the various time as well as days of the week, right? And intuitively, as you would also know, right, weekends are far more busier in shopping areas, whether high street or malls, etc., compared to, let's say, some of the weekdays and, the first half versus the second half. And therefore, how can you utilize your manpower right? Because you can also have lost opportunities on weekends, whereas you can have basically, idle or extra capacity from a retail manpower perspective on some other times during the week. So to make sure that is balanced right, that is what the entire concept of flexible manpower is. Simultaneously is also basically making sure that key indicators besides turnover and, as I mentioned, this entire thing of retail excellence is also linked to their incentives. And therefore, that also aids the entire variabilization of cost structure in a way. So I think these are the two things that, I can respond to you right now. And we will see the impact of this coming through.
Sure, sir. Thank you.
Thank you. The next question is from the line of Swagato Ghosh from Franklin Templeton. Please go ahead.
Yeah, thanks for taking my question. Sir, a follow-up on the gross margin. With the mix that we are targeting, what is the sustainable level of gross margin that we can expect?
So, Swagato, I have answered this question, right? There are several levers that we are working on, right? Obviously, there will be reversals of some of the one-offs that we have talked, right? We see the retail scaling up and therefore flowing through into the margin line. And the last piece is, as I said, there are forward-looking cost levers that we are working on, which I had elaborated in a previous question. So all of these combined together, we are hopeful of the trajectory continuing going forward, notwithstanding some COVID flip that might be there.
Okay, sorry for missing out on the last question's response. I had some technical issues. But what is the number? If you can just repeat on the gross margin side, what's the target? Can we go up to like a 50% number?
We don't give a forward-looking statement, Swagato, so I'm sorry on that front.
Sure. Okay, and the second question is, we have Disha Patni as our ambassador. Quick question on that. So we have in the past always had stars, but more like film stars versus A category stars. I just want to understand the thought process behind that, and I sincerely believe that with the A category star, maybe our brand can get a step up versus what the strategy has been. So your thoughts on that, please?
See, it's also various segments, Swagato, and in our view, I think the kind of target segment where we want a dial-up happening, so Kartik Aaryan has been with us, right, continues to be. We ran a campaign last quarter, right, so these people and stars or celebrities, they connect with the target segment where we want the dial-up to happen on engagement with the youth, with the kind of quotients on fitness and fashion that we want dial-up. So it's a question of what we want, and therefore what is the right celebrity to associate with is where the rationale fits in.
Got it. And on the last question on the premiumization part, the targets that you have set out internally, like without disclosing what those are we on track to achieve the mix in favor of the premium products, or do we need to do something else, something incrementally to kind of drive that?
No, we will see premiumization has been a journey for some time. While obviously I think the mix got a little impacted during this COVID times and open footwear, etc., started getting sold much more, right? But it's we can see that balancing back. But from an apple-to-apple point of view, I would say that our ASPs have continuously gone up. In fact, our retail ASPs are now nearing 1,000 rupees, right? And we should see them, with the mix, with sneakers going up, etc. For example, just to give you an example, the sneaker ASP is in the range of almost 2,000 rupees, right? The floats, one of the big new product categories which we are looking at very ambitiously going forward has got an ASP in the range of about 1,300. So all of these will keep moving up the entire ASP trajectory, while notwithstanding the fact that distribution business, etc., is at a lower ASP by nature. But as I said, in that channel, apple to apple, we will see premiumization also happen.
Got it. Thank you. Thanks a lot.
Thank you. Participants are requested to limit their questions to one per participant. The next question is from the line of Kapil Jagasia from Edelweiss Financial Services. Please go ahead.
Thank you for taking my question, sir. Sir, with this easing of lockdown restrictions, like earlier we have seen our portfolio shifting, more focused towards the casual portfolio because of this hybrid work from home scenario. Now, with this easing of lockdown restrictions, do we see, gradually shifting our portfolio back to formal footwear, and thereby, also increase the average selling price which used to be before?
Kapil, see, there are two things, right? One is that there were short-term trends and then there are longer-term trends. What I have talked about in my strategic levers, which is the casualization and the sneaker agenda, etc., is basically working towards a longer-term strategic trend. It is something that when you study the market and see the trends and various data sources was evident even pre-COVID. So it's not just a COVID phenomenon. Right, it got accentuated a little, might balance back a little, but the longer-term trend will continue. But notwithstanding that, as I mentioned, sequentially we saw formal as well as fashion bouncing back, and I don't see a reason why that should not come back even more strongly. As I said, the sentiments and the lockdowns consistently keep remaining open, and similarly my comment on schools, etc. also.
Thank you. Next question is from the line of Akhil from Central.
Thanks for the opportunity. So my first question.
Akhil, you're not audible.
Hello, is it better now?
Yes.
Yeah. So my first question is on the expansion on the MBO side and the franchise side. Like Bata has been known for its retail COCO stores historically. Do we anticipate a kind of a brand dilution if Bata footprint is available in nooks and corners, basically because of the MBOs and the franchise?
No. So, categorically no. The reason being that basically it's the question of what product do you offer to consumers. If the consumer is looking for Bata, then I should be available. That's the basic premise. And if the consumer is looking for Bata, my brand is what it is, right? So the premise works the other way around, right? If the consumer is looking for Bata, it should be easily accessible to the consumer, right? Simultaneously, what also, as I said, is basically, some of the other points that I mentioned, which is on the product and the portfolio piece. The second piece is the marketing investments that we keep putting on in terms of making it more youthful as well as the premiumization journey. Right, and lastly is obviously your product, technology, quality, and the trust that is built behind it. So all of these combined together, I would say a categorical no on the question that you raised.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So a couple of questions from my side. First is on the absolute number of EBOs. You have mentioned we have 1,560 odd EBOs today. FY21 we have 1,525 odd EBOs. So bulk of the addition is coming on franchisee route. Are we closing our own stores down partly, due to them not being fruitful after COVID, and hence will our rental cost structurally come down or remain flat because bulk of the stores would be on a franchisee route?
Directionally, I think franchise will be a large part of the store additions. But however, as I had mentioned a little while back, we did see rationalization of non-profitable stores in the, let's say the trailing 12 months, etc. But going forward, we will also see COCO expansion, which is the company-operated stores, right? But predominantly, I would say that let's say around 70 to 80% of store additions will be driven through the franchise route.
Thank you. The next question is from the line of Girish Pai from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. The question was regarding the PBT margins. Gunjan, do you see the PBT margin go back to the 16.5%, 70% levels of FY19 in the times ahead? Obviously, there is a channel mix change which is driving down your gross margin, probably even EBITDA margin. But from a PBT margin perspective, do you see the company going back to the FY19, FY20 levels?
Yeah, Girish. So I don't give forward-looking statements, but the endeavor is not only to reach back, but even go further ahead. And the levers is what I just mentioned to another participant some time back.
Okay, thank you.
Thank you. The next question is from the line of Kunal Patia from Dalal & Broacha. Please go ahead.
Yes, sir. Thanks for the opportunity. So I just had one question. So you did mention that franchisee plus distribution this quarter was 20%. So just wanted to know how much was it pre-COVID quarter, and also in terms of you've been mentioning about the ASP rise on our retail business. So could you give a comparative between the pre-COVID level and now how has been the ASP in terms of the retail store end? Yeah, and that was my question. Yeah.
Okay. On your first question, as I said, ballpark at about 20% contribution, pre-COVID in the range of about 10 to 12%, so a significant outperformance from that perspective. Obviously, aided overall recovery, the larger points that I've already made. So I hope that answers that point. On the piece on the ASP piece, as I mentioned, retail per se, we have seen now the ASPs move to the range of about just short of 1,000. In fact, 970 to be exact, and we see no reason why that premiumization journey should not continue.
So how much was it pre-COVID?
It's about 10% higher than pre-COVID. A little more than 10% higher.
All right.
Thank you. Next question is from the line of Shankarasan Mehra from Premji Invest. Please go ahead.
Hi, thank you for the opportunity. Just one question. So, your retail channel is not back to pre-COVID yet in terms of recovery. And your comments suggest that, it's gross margin accretive as well. So, I just wanted to know, if you could highlight any steps you are taking to accelerate the recovery in that channel, any store addition targets that you can share or, any other milestones to talk about?
Yeah, so I did talk about this, multiple levers on that front, right? One is this entire piece on retail excellence, therefore driving same-store growth. The second piece on that front is also making sure that, our category as well as marketing work on certain key categories where we see the growth drivers getting more accelerated, continuing the positive momentum that we have seen and payback for investments on sneakers and casualization. The third piece is our entire renovation investments behind our stores and therefore working towards the 20% of the network getting completely refreshed. And the last piece, as I said, is that we had also done a lot of rationalization of non-profitable stores. That has come to largely an end, and now we will see obviously additions. But as I said, primarily 70-80% of our additions going forward will still be driven through franchise.
Sure, that's helpful. And any broad timelines on when you want this to be done with, the 20% renovation to be done with, and where we can expect after which, the SSGs to improve?
Some of them are ongoing, but I think the 20%, as I mentioned, is for the year of 2000, so by December 2022.
All right, that's helpful. Thank you.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to the management for their closing comments.
We thank you for joining the call, and if you have any questions, you can write to us at the investor relation details given on the website. Thank you. We look forward to your cooperation.
Thank you. Thank you for your time and the questions. Thank you so much.
Thank you. Bye-bye.
Thank you very much. Ladies